Hello, this is Philip at the Laptop Trader channel on YouTube. Welcome back to our community. This month will be Chapter 2 in our 12-part Investor and Trader education series. I'm just here to share my experience and give back to the stock investing and trading community one video at a time. So good luck. My contact is laptoptraderphil@gmail.com. This is going to be a very basic video, okay? But start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself and then invest in the markets. So in chapter 1, we just covered some recommended reading, become financially disciplined. You should fund your employer-sponsored retirement plan. What was the relationship between interest rates, the inflation rates, and your money? What type of return on investment would we wish to achieve? Preferably something greater than inflation. And then why can't we get ahead, and kind of what's in my control and how can we get ahead? That's just kind of what we went over quickly in chapter 1. Our agenda for chapter 2. So this is very basic. This is what I would want to know if I was a new investor or a new trader to the stock market, even if I'd never invested before. So that's why I made this series. So just the questions I always had for myself, what is the stock market or a free market? What is the stock or a share of a company? How does the stock market really work? What should I invest in? Stocks or mutual funds or ETFs or index funds, which is best? Who am I? Am I an investor or a trader? You may not know these questions, or you may not know that answer yet. What are the costs of investing or trading? When do I buy or invest? How will my money grow? What's an ROR? And ROI or ROC? What do those mean? Using position size and money management for traders, because we have a limited supply of money, so we need to watch how much we invest or trade. Why is this a good investment or trade for me? What type of analysis are we going to use? We need to be selective if we're going to pick individual stocks. Why is price or price movement king? What is volatility? What is a price chart? Different information platforms to consider. And then 3 areas I do not trade in and why. So just starting off with the basics, what is a stock or a share of a company? So a stock or share is simply a piece of ownership of a public company. Sometimes private companies also issue shares. But for this discussion, we're going to focus on public companies. So if you were to buy 10 shares of a company, symbol ABC, and the shares available or outstanding shares are 1 million shares, then you own a very small percentage of that company. However, but you still get to participate in any gains in the share price and any dividends that are paid out to shareholders. You will have no say-so in how the company operates, and that is okay. Your main concern or your goal is price appreciation of your shares or your position. You're simply looking for an ROI or a return on your investment. What is a stock market or a free market? A stock market is just a place to buy and sell stocks of companies and is open or freely open to those that wish to trade or invest their capital. There used to be many more barriers to entry, like account size or high fees. At one point in time, they used to want you to have at least like 6 figures, or you couldn't open an account at some brokerages. But today, it's really easy to access. At one time in the past, there were free markets, but not like today, where we have large exchanges, like the New York Stock Exchange. They used to allow retail traders to trade or invest in shops, and these were more like gambling shops. And the advantage was for the house or the shop owner. Many times the owner would charge high fees or large spreads between the sale and the purchase price to make money on the transactions. These were very similar to modern casinos, who have an edge over the gamblers. Today, around the world, there are exchanges which act as middlemen between buyers and sellers and other market operators, such as brokers and market makers. A market maker provides a willing and able buyer or seller at all times to make a liquid market, so transactions can happen quickly. At one time, there was a big delay for retail investors between purchase and sale. Sometimes up to a week. Today, your transactions happen almost instantly. A broker is the company you use as a retail trader to enter your transactions with online. Today's market environment is more friendly than ever to small investors and traders with easy access and low transaction fees. They want your business, just like a store wants your business for groceries or home supplies or clothing. Today, there are over 8,000 stocks. So, how does the stock market really work? And this isn't printed here, but one thing that got me really looking into the stock market was a feeling of frustration, where I would read an article either in a magazine or newspaper or online, and it would go something like this. If you had invested, $1,000 or $10,000 back in, whatever year into something like, Apple company or Amazon company, today your investment would be worth, usually in the millions. It'd be worth $1 million, let's say, or it'd be worth $5 million if you bought $1,000 of Apple back in 1982 or whenever that company started. And that got me so frustrated because one, I never had the $1,000 or $10,000 to invest, and two, who had the foresight to even see that Apple would be this great company or Amazon would be this great company today? So that's kind of what got me going down this rabbit hole. But essentially, the market works as a giant auction system, and buyers or traders have the opportunity to buy or sell at the current price. You can pass or play if you wish, and wait for higher or lower prices based on your analysis. The main driver of prices is simply supply and demand. If there is a large supply of stock for a company and very little demand, prices will stagnate or consolidate at a certain price or even decline or depreciate in value. If there's a large demand for a popular company or product or service and the same supply or a low supply of shares, then prices will go up as investors are willing to pay more. Again, think of Apple or Netflix, two very popular and very profitable companies. There are a few other main items that affect prices in the market. When companies become favored and profitable, investors in general are willing to pay more today for future profits and growth of the profits of that company. That's really the basics of how pricing happens. It really is just supply and demand. So because investors are willing to pay up now for future growth, the market as a mechanism is sometimes described as a forward-looking pricing discount mechanism. So that's a pretty long description, but this is not always easy to understand, and I think the media generally gets this idea wrong. And here's why I think that is. The number one word on Wall Street for investors is growth. We have to remember that all companies at one time were just an idea for a new product or service. Today's large companies were at one time new ideas. Think of today's modern aircraft industry. At one time, there were no planes. People walked or rode horses or trains. took buggies or however they got across long distances. So therefore, one thing we are always looking for is new ideas or new technologies for new industries that with proper care will grow into new companies that pay us back as investors. These companies will pay us back in either increased stock prices or dividend payments or both. This is how we get an ROI on our money, and our money grows. So new company comes to market, new idea comes to market. We get investors to put their money into this new company, and then as it grows, hopefully it becomes something big, and that will give us a growth on our hard-earned dollars. So one way this can be expressed is through ratios. Some of the most popular ratios are PE, or the price earnings ratio, or the price divided by sales ratio, or the price earnings to growth ratio, and there's many others. There's probably at least 20 or more. But these ratios can offer us a quick glance at a company's performance over a period of time. So that's one way that we can quickly sort through information is through using ratios. And we can show you examples of that later in later videos. These are just basics. But one thing about all the information in the market is there are thousands of full-time employed analysts who study major companies and apply valuations to them. These employees work for large investing firms and do this full-time. Each firm does this a little differently, and they will use ratios and other tools to establish the value of the company's stock that they wish to purchase or sell. So it's a whole industry just analyzing stocks. One way we can save time is to see if we can watch these large firms called institutions buy and sell in a big way. Okay? So this leads us to technical analysis and the study of price and volume using price charts. So we're going to try to follow the leader, in other words. That's what we're looking for in stocks. We're looking for growth, we're looking for supply and demand, and we're going to see if anybody else is looking for the same thing. So using technical analysis and price charts. Price chart is nothing more than someone or a computer plotting price on a chart over any period of time. There are several styles of charts, including line charts, bar charts, candlestick charts, area charts, and others. Myself and most traders will use candlestick charts, as they provide detailed information about pricing for that period of time. By using price and volume, or the number of shares traded on a chart, we can literally see in picture form major purchases or sales at certain levels on a chart, sometimes referred to as institutional volume or professional volume. We can also see supply and demand quite clearly most of the time, and therefore we can also see trends. We may see an uptrend or a downtrend or something in between. Because of this technical analysis, we can make buying or selling decisions for ourselves. This allows us to play along with the large players in the market. So what stocks or funds or mutual funds or ETFs are best? This is going to depend on you. It's a personal choice as to whether or not to buy and sell individual stocks, or to buy a group of stocks and diversify your investments in a fund or a mutual fund. Mutual funds are generally run by large companies like Vanguard or Fidelity or others and offer great value, low costs, and risk spread across many stocks or markets, and offer a diversified approach and a professional management. This is generally considered a safe investment. You don't have a choice of what is in the mutual fund. You simply would purchase a mutual fund of a basket of stocks, and that's your investment. The stocks will be priced as of that moment you purchase it and may go up or down in value. Individual stocks may offer higher reward, but also higher risk, as your money is only with that company versus a basket of stocks in a fund. So in a fund, your money is spread out among many companies, already reducing risk, right? That's why you would buy a basket of companies versus a single company, is to reduce risk. So an ETF or an exchange traded fund is similar to a mutual fund, but you could purchase or sell it yourself without calling the fund and requesting a transaction, or going online and requesting a transaction. ETFs are also very liquid and easy to enter and exit, just like a stock. So for example, Vanguard Company will have an S&P 500 mutual fund you can purchase, or you can buy an ETF which tracks the S&P 500. A very famous one is the symbol SPY or SPY, for similar exposure to the S&P 500 market index of 500 stocks. So whether you buy the mutual fund or if you were to buy the ETF SPY, you would have essentially bought a basket of 500 of the best stocks, and both will have very similar performance. There are many funds and ETFs to choose from. There's hundreds of them, and some will focus on a certain industry or a certain sector, like energy, for example. Some will focus on growth or income or value, and it's up to you how much you put at risk. And so that's a subject unto itself, ETFs and different funds. There's even, like my employer offers what's called a target date retirement fund, where, let's say I can invest so much money per week now, and then my goal will be to, let's say, to retire in, 2050 or something like that. And they can target, even those are more popular now too. Anyway, this is where you need to do some honest homework and figure out who you are and where you are at in life, so you choose an appropriate investment for yourself. So that's going to need some homework. It's going to be a personal decision. Whether you do it yourself or not, if you're not sure, please seek an investment advisor, if you need help. So this brings up a question: should I be an investor or a trader, or both? Well, personally, this is up to you in a free market. I personally am both an investor long term in my occupation, my ongoing study of the markets, my 401k mutual fund, my pension plan, and my trading of individual stocks and ETFs. So I do both. I like the process of trading and the mental aspect of thinking about my trades, because one thing about it is there's a lot of strategy to it, and it can be fun. Long term, I like the stability of my retirement plan at work. I think if I was a brand new employee, I would seriously consider investing in my employer's retirement plan and contributing as much as I could to it sooner rather than later, and putting time on my side. So when you do that, you really get compounding interest working for you sooner rather than later. Most often, this plan will give you a limited choice of growth stock mutual funds. So when you invest through your employer, you'll only have usually 20 or 25 or less mutual funds to even choose from. They're not going to give you thousands. They're going to give you, kind of what they sell. Compound interest really does work over time, as your return on investment compounds and your money will grow for you. And I would recommend checking out the compound interest calculator at investor.gov, or just type in online, compound interest calculator, and run some of the numbers for yourself. If you want more trading education, stick around and watch our monthly market videos on how I put my trading plan into action using technical analysis and price charts. Trading is a high risk endeavor, but using risk management and trade management helps reduce some of those risks. But the choice is yours, and good luck with that. What are the costs of trading or investing? So we talked about some of the benefits, right? Investing for the long term so that your money grows, you get an ROI. Someday you can, hopefully retire, not work anymore, stuff like that. But there is cost to investing, and they used to be quite high between 1900 and the 1960s. When Jack Bogle founded Vanguard Company, he sought to bring down these costs with low-cost index funds that invested in the total stock market. These mutual funds or index funds gave you diversified exposure to the market, meaning if the markets went up, your money went up, and when the markets went down, your money would follow the market down. And over time, this essentially gave you the average market return over time of about 10.5% on your money. Before this, funds did not cater to the small investor. They catered to those who already had money, very similar to today's hedge funds. The cost of trading used to be oppressive, and also trading was reserved for those with access to seats at the market. If you wanted to trade, you had to pay high costs for entry and exit per trade through the exchanges. This favored large operators. Markets also used to have high bid-ask spreads, and shares were priced in fractions, like 1/8 or 1/4. So maybe IBM, maybe trading at 52.25 per share. Today, with decimalization and lower fees, and stocks trading in decimals, not fractions anymore. Sometimes there's no fee and tighter bid-ask spreads, many times in pennies. The markets have become much more accessible and even, I would say, democratized. And now operators want retail and small investors' business. There are other costs to consider, one of them being the opportunity cost. What is the cost of not investing and missing out and having a better financial future? So that's one to think about. Another cost would be if you trade too much per trade and blow up your account. Now you're out of money. So risk management is key there. What is the cost of not learning and increasing your knowledge of the markets? I consider investing a lifelong learning experience. It's not easy, it takes time, but in my opinion has given me confidence and has been well worth it. So when to buy or invest or enter a trade? This is again going to be a personal choice depending on your current finances, your budget. Do you have money to invest right now? You may or may not. And your financial statement and where you are at in your life. But through education on the markets and practice, you should become more comfortable with investing and or trading. So if you don't have any money to invest right now, I know how that feels. But I would strongly encourage you to get with it, save some money to invest. The easiest way, again, is through your employer and a mutual fund through the 401k plan at work. That is because it just comes out of your check. It's like mindless. You don't have to think about it, and you won't miss the money. Trust me. So as far as trading, for me personally, I've been an investor since about the year 2000, and a stock trader since about 2019. I did not always have the money or the confidence to be a trader, and that's okay. There's nothing wrong with working hard and saving money in a mutual fund with your employer's retirement plan. I know personally many millionaires who did just that. It may take 30 or 40 years, but the system works. I think everyone should at least be an investor. And I compare investing to, buying a house and investing in a house. It's a long-term process. Nobody ever really sees the hard work you put into your house, but 30 years down the road, I think, most people that own homes are happy that they bought a house. If you wish to trade in stocks, then you need to start learning more about risk and reward and money management on how to evaluate companies, either with fundamental analysis of a company's numbers or technical analysis of price movement on chart, or both, or even quantitative analysis. Because then you can come up with a plan that makes sense for you that you can follow. For example, in my plan, I never buy a stock in a stage 4 downtrend or a stock showing relative weakness versus the market or its peers. From a fundamental view, I don't like to buy stocks with, declining earnings per share or no earnings per share. Some companies just don't make money. If you don't understand this yet, it's okay, but stick around and stay tuned until you become comfortable with the terminology. How will my money grow? This is fairly easy to answer. You're just looking for a return on investment, or ROI. And that's the most widely used metric for growth. So if I invested $1,000 in a fund or a stock and it grew 10%, it would be worth $1,100 at the end of that period of time, usually quoted on a yearly basis, or 10% per year. So if I made no more contributions and earned another 10% on the 1,100, it would now have a total value of $1,210, compounding my gains or my returns. So ROI can be used on any time frame. So if you gain 10% in a month, then that's really good. Compounding is how you win in the financial game, period. Some traders use return ROC, which would be return on capital, or ROR, return on risk, as a way to identify specific risk per trade or position. This just allows them to be more accurate and a way to evaluate how they are performing per trade. If I had a position of $1,000 in a stock and I used a stop loss strategy and reduced my risk to $100 for that trade, then I could calculate my ROR or ROC against the $100 at risk. If I gained only $50, then that would be a ROR or ROC of 50%, and an ROI versus the total 1,000 invested of 5%. ROR and ROC are essentially the same thing. Just be aware of other traders using this terminology. I think now you can see why traders wish to use strategies to actively reduce risk, as it inflates their returns and performance while reducing the risk in any one trade. So that's just a little bit about how a trader thinks versus an investor. They're just a little bit different thought process. What is risk management or money management? This is going to apply more to trading, but really money management applies to everyone. But money management starts at home with a written budget or spending plan for your money. If you haven't done it yet, get it done. It will really help you with discipline and money management in the markets. Why? Because for most people, money is an emotional topic, even though it is just a financial tool. It should be neutral, just like a hammer or a screwdriver. If you're going to actively trade these stocks, then money management is crucial so that you do not make rash or emotional trading decisions and cost yourself money. Second, and just as important, you'll have losing trades, and losing never feels good. If you set up your risk up front, then at least you can live to fight another day without losing all of your money. One very famous trader who made millions after blowing up several accounts learned the hard way about money management. In fact, as a successful trader, he only has about a 30% win rate. In other words, he loses 7 out of 10 trades and still makes millions because of money and risk management and discipline, not because he is a great stock picker. Ignore money management and risk management at your own peril. Think about it. If you do not have the discipline to say no to fast food 3 times a week, and you can't manage your money, do you have what it takes to trade stocks? So these are just some 3 basic rules that I share with everybody to limit your risk up front before you ever enter a position. And your account size does not matter, but you should use risk management with individual stocks. Have a trading plan with specific things to look for positive and negative, as to what is a good investment for you or a trade for you. Limit your position size to some sort of a percentage or a dollar amount per trade of your account size. I call this my catastrophic loss or my gap rule. What will cause sleep loss if a stock goes to zero or the company goes out of business overnight? And that happens. You can't lose what you don't put at risk. Okay, so two famous companies that were out in business one day and out of business the next were Enron, which is a very famous case, and more recently Silicon Valley Bank. So those were two famous companies that went out of business very quickly, and people lost their investments. Finally, traders will generally use a stop loss rule. This essentially allows you to buy more shares, called share sizing, and you can further reduce your risk by using a stop loss. So if you're a new trader, you could use, for example, a $10 risk per trade. So even if you had, tens of thousands of dollars to trade with, if you're brand new, keep your risk low. Use something small like $10 of risk per trade using a stop loss. So if you had a $2 stop loss, you could buy 5 shares of that company, and that would equal a $10 trade risk. I know that sounds small, and but it's a prudent piece of advice that I took a while back. And then later on, as you get comfortable, you get some experience, you can increase your risk. Okay. Be selective of your investments or trades. If you're a passive investor in a mutual fund, you won't have any choice really in the investments in the fund. They do it for you. You can only select pass or play on that specific fund. If you choose individual stocks, then you're going to need to filter through over 8,000 stocks. Which one do you choose? So we need a filtering and selection process to do that. We could do that pretty easily today with software and our platforms online, or even our online broker. If I'm a brand new trader or investor today, I would start with what I know. I would start with the company I work at, if it is a public company, and see what public information I could learn about that company. Then I would expand my search. I would select maybe 5 or 10 companies that I know, like Walmart or Apple, and research them and see what information I can learn about companies I know. Then I would watch every week or month charts or news reports or earnings announcements and see what happens. Does the price of the company I'm looking at go up or down? Is there any growth news about earnings per share or sales growth, or revenue growth is a big one, user growth. But again, growth is the number one word on Wall Street and in the markets. It really drives demand. Earnings reports are the number one event for public companies. They generally happen every quarter or 4 times per year. So how does your company react to this earnings event? Many times there are gap ups or gap downs around earnings events, which can cause share prices to kind of swing around kind of wildly. But again, are there growing sales, growing revenues, growing earnings per share, growing users, growing net income, gross profits, net margins? These are terms you need to get familiar with, because if you've got growth in some of those areas or all of those areas, that's what Wall Street is looking for. So which type of analysis do I use? What makes this a good investment or trade for me? So we must answer this question if we're going to buy individual stocks or even a mutual fund. What makes this mutual fund or ETF a good investment for me? Because there's no guarantees in the market. Technical analysis is just a study of price graphed on a chart over a period of time. It may be a day, week, month, year. It may be over a minute or 5 minutes too. It just depends on if you're a day trader or a position trader or a swing trader or a longer term investor. Okay, so it does not matter which time frame is. All the charts will look very similar. Price can only go up, down, or sideways in any time frame. I personally use monthly, weekly, and daily time frames for my selection. Price analysis is considered true as you cannot lie about a purchase or sale as it will show up in the data. For example, an analyst may upgrade a stock after a large move up, and at the same time a large fund is selling the same stock. And this happens all the time. So it's very tough to trust analysts who are not working for you. They're working for big firms, and that's just the way it is. Fundamental analysis involves the study and comparison of the company's fundamental numbers or metrics of their business. If they are a public company, they're required to make this information public for investors. The only problem with fundamentals is that people lie, and CEOs like to stretch the truth and never talk bad about their company they represent. Essentially, they really can't talk bad about their company. They've got an obligation to promote the company that they work for. Again, a famous case was Enron that went bankrupt. I do use some fundamentals in my analysis. Okay. Quantitative analysis, sometimes referred to as quants, look to analyze all of the available information and price data of a company or a market and assign a value to that versus other companies. So they may assign maybe a 0 to 100 value or some other metric where they assign a number to a company, and usually the higher or lower the number, whatever, tells them that this would be a good investment for their quantitative fund. Quants use very smart people and computer programs to try to gain an edge over other market participants and have had some success in doing so. By using their skills, they come up with specific buy and sell rules on stocks they have identified as having higher probabilities of going up or down and profiting from these moves. Some famous quant traders include Jim Simons, who was a very successful quant who recruited mathematicians and others from universities to work at his fund. I forget the name of his fund. But some platforms like Seeking Alpha and Barchart.com do have some quantitative numbers that you can use as a retail trader or investor. They're essentially looking for the strongest stocks in the strongest industries. Is it any more successful? I'm not sure, as many famous traders using charts have become very successful as well. Is it valid? Yes, it is valid research. It does work. But Warren Buffett, who says he does not use charts or quants, is arguably the most famous trader or investor of all who succeeded in picking individual stocks. I think it comes down to what makes sense to you. How much time do you have to commit, and what are you comfortable with, and what skills do you have or can you learn to help you focus on stock selection, okay? Then you could clearly answer, is this a good investment or trade for me? So when I do this, my analysis, I can quickly come to a decision, within seconds or minutes, not days or weeks. So I don't spend a whole lot of time on my analysis, but in general, I have had some success in, through my trades and investments. Again, we've already discussed what a price chart is. Again, it's just a visual representation of what buyers and sellers bought or sold, whether it is a stock or ETF or commodity or anything else, or even a currency. But early stock traders used to graph prices on pieces of paper. Today we can go online and access chart information. It takes a little practice, but I think it's worthwhile. One of the things about price charts is that, let's say, out of all the investors in the market, there's a large percentage that are funds, a large percentage that are institutions, there's some quants in there. But when everybody kind of recognizes a good value or a good stock that they think is going to go up, it's like everybody goes in at once. And so you'll see that in volume and price fairly quickly on the chart. But price is king because that's how we make or lose money. So if we buy a stock and it moves up, we make money. If it goes down, we lose money. Simple. It doesn't matter what the nightly news or the financial news thinks. In fact, I think the financial news is very poor. We either make or lose money on price movement, period. If a company has a great quarterly report with growing sales, but the stock gaps down in price, does the report matter if we lost money? I don't think so. And that happens. You may have a great quarterly report and the stock goes down in price. That happens quite a bit. But price is king in the markets. And supply and demand, again, is what drives prices. So you may have a good quarterly report, good annual report, whatever. But if demand is not there for that stock and the stock goes down in value, then a lot of that research time you wasted, it didn't really matter because you may have still lost money. This is something that I didn't know when I first started, and that's the idea of volatility. I didn't know what volatility was. And honestly, I didn't know what a stop loss was when I first started either. So that's why I'm sharing this information. But volatility is simply the amount the price moves in one direction, usually out of a normal range. So a stock may have a normal range of, let's say, $1 a day. And let's say the day after earnings or before earnings, whenever, let's say it gaps up $3. And so that would be like 3 times its normal activity. This would all of a sudden be considered more volatile for that period of time. Generally, volatility to the downside is higher as most investors like stocks to go up. So think of fear to the downside or loss of capital. That can create some real volatility. Volatility can also be seen on a chart. Many times large moves up or down repeatedly will be considered increased volatility. So maybe like the stock is real stable and all of a sudden a lot of selling comes into that stock, or we have a market sell-off, market crash, and all of a sudden volatility will just spike up. And there's ways to there's definitely some strategies around volatility. That's a little bit too advanced for this course, though. I just wanted you guys to be aware of that. So let's just give you guys some examples of a price chart. Okay, this would be a price chart, a line chart of the S&P 500 Spider ETF, symbol SPY, or the SPY. So this is probably the most widely followed ETF out there, next to the NASDAQ ETF QQQ. Okay, those are probably the 2 most widely followed markets and ETFs. But you can just see a line here going left to right, showing where price was at any point on this chart over. This is a 2-year period. See that weekly, 2 years. Okay, so over a 2-year period, this was the price of the SPY. And on the volume, on the bottom is a volume graph showing, whether it was increased volume or decreased volume. Here's a volume spike, and then this is just kind of, you can see by looking left to right or right to left, you can just kind of see where the average volume is, and then you can kind of pick out here was a spike, maybe here was a spike, here was some spikes here to the left. So traders will pay attention to those volume spikes. But that is just showing, if we looked all the way left, here was price here. If we looked all the way to the right, you could see that over a 2-year period, this fund, this ETF, appreciated over this 2-year period overall. Now, in between, we had some selling, right? We had some low points, and we had some high points, some low points. Here's a high point, and then a low point. So markets are not static; they move around quite a bit. But generally, in the long term, markets go up. Individual stocks are different. Individual stocks can and do simply stop trading. They get delisted, they go out of business, whatever. So it's very important to understand the difference between markets and ETFs like the SPY, which represent a major market, and individual stocks. Here would be an individual price chart using candlesticks of an individual company that most should recognize, Amazon.com, and it trades under the symbol AMZN. So if you're ever looking up a stock, you would simply type in the search Amazon stock or type in the symbol, and it should give you some stock information. So this is just price on a graph using candlesticks. Again, you would still read the information from left to right, but the candlesticks simply give more detail than a line chart. And most traders will use green and red candlesticks. Some may use hollow candlesticks or black and white candlesticks. I think I like the colors better myself, but green just means the price opened at the bottom of the candlestick or the bar, and it closed at the top. Red means it opened at the top of the candlestick or the bar, and price closed lower to that for that day or week or whatever you're looking at. Okay, so that's the only difference between green and red candlesticks. And then I'll use moving averages. That's what this blue, green, and red line are. Those are just simply moving averages, which is the average price over any period of time. And then on the bottom here, again, we can see some volume and some volume spikes, and just what happened as far as buying or selling pressure based on volume for that day. And this is a daily 9-month chart. So each candle is 1 day's worth of price action, and this entire chart is a 9-month period of time. Okay, so we can put any time frame we want on a chart. This would just be another example of a famous company, right? Coca-Cola Company, symbol KO. And we can see here, this is a monthly 5-year period. So each candle or each bar is 1 month of pricing or price action over a 5-year period. And we can see if we looked all the way to the left, price closed here at the bottom of that red candle. If we move to the right, today our investment would have appreciated a little bit, not much, but it would have went up in value over that 5-year period of time based on this month's or this week's closing price. And so you could also see volume on a monthly basis. So here's a price volume spike, here's a volume spike, and then you can just kind of see what average volume is in between there. Okay. And the E stands for earnings. So those are earnings events or earnings announcements. And so we can look up earnings information on any sort of information platform also, whether it has growing earnings, growing sales, all this different earnings information we can look up. So right now, it just looks like Coca-Cola is in a, kind of a long-term uptrend. It had a short-term sell-off here. You can see how price declined. This will be an uptrend here over several months. So this will be more of a downtrend over several months, and this will be more of an uptrend over several months. So prices go, back and forth over time. This is again the SPY. This will be a weekly 2-year chart showing, kind of a downtrend here, and then transition back to an uptrend on a weekly chart. This will be a 2-year weekly chart of that ETF. So those are some chart examples. And then in other videos, we kind of show a little more about how to use charts to make money and how we look for possible entry opportunities, exit opportunities, some trade management ideas and stuff like that. So, but for the basics, that's what charts look like. These are some charting or even information platforms to consider. Some of these have free levels or trials and paid subscriptions too. I don't have any particular order or any recommendation. I personally currently use Barchart, but I have used other platforms such as Finviz, StockCharts.com, SeekingAlpha.com, TradingView, eTrade. All are pretty good. All have, pluses and minuses. It's just a preference of how they present the information, how easy it is to read or find information. It's up to you. But here are some others that you could consider, such as TradeStation, Schwab. There's the Thinkorswim platform through that. eTrade. It's a trading platform, free charts. The charts have improved over the years, but I like to be able to search through the charts on Barchart.com. Seeking Alpha has a lot. If you really like the fundamentals, that's a pretty good site for fundamentals. StockCharts.com. Again, you can customize charts and lists and stuff like that. Create different chart lists so you can sort and segregate different investment ideas or trading ideas. TradingView is very popular. It also has like a social community. Finviz is very popular with traders. But you could also, if you want free charts, just try to type in the name of a company into Google or Yahoo, and you'll probably get some free info in a chart fairly quickly. And there's others that I probably didn't list, but those are just some ideas. There's 3 areas I choose not to trade in. One is biotech stocks. Individual biotech companies for me are too volatile and can be good one day and not so good the next, even out of business the next. They generally do not make any money. And there can be a moral objection to biotech companies for some people. But I would consider, and I have invested in biotech ETFs because they have more of a basket of stocks, reducing my risk of any one company in that industry. Okay. New IPOs or initial public offerings. These are new companies that come to market that generally do not make money, and they usually sell off after coming to market. Not always, but usually. They may even go up at first, but most sell off considerably. After a year, I will consider them after they have some sort of performance history or are very popular, companies like Uber. So just go and look up a chart of Uber, and you'll see it came to market, went down in value, and then as it became more popular, their price went up a little bit. Cryptocurrencies, yes, they're popular and have increased in value, especially the top ones like Bitcoin, Ethereum, Cardano. There's hundreds of them now, to be honest with you, these cryptos. But none of them really have any real underlying value or profits. And there really is no way of assigning value. It's just whatever the market is willing to pay at this time. It's just price going up or down. And most are really not used as currency. But time will tell. It's definitely new technology. It's a new industry. But I would rather invest or trade in something I understand and that makes money, and not have the risk of crypto going to zero. If you like cryptos and you're comfortable with them, that's fine. But that's just my preference. No, I don't have anything against cryptos. But for those reasons, I currently don't have any cryptocurrencies. Using a pre-trade checklist, we're going to go into this more, I think next month, either in Chapter 3 or Chapter 4. This allows us to make a list of positive things we see on a chart, more positive things going for the particular company, like the better or more probable that the trade will work as intended. So we're looking for higher odds of success by using a pre-trade checklist that can quickly help us get through multiple charts. Okay. Anyway, I think that's long enough. That's all for Chapter 2 in this 12-part series. Thanks for supporting and subscribing to the Laptop Trader channel. My handle is at Laptop Trader on YouTube. Be sure to tune into our monthly market video for in-depth technical analysis. Any questions can be sent to that email, laptoptraderphil@gmail.com. We'll see you next month for Chapter 3. Thanks again. My name's Philip. That's all.